Hi, my name is Roshan, and today we're going to be talking about closing entries, also known as closing all the journal entries. Closing entries are entries made at the end of an accounting period to zero out all temporary accounts and transfer their balances into permanent accounts. The two accounts that are going to be talked about while discussing closing entries are permanent accounts, which are balance sheet accounts including assets, liabilities, and most equity accounts. These account balances roll over into the next period, so the ending balances of this period will be the beginning balance for the next period. The second type of account are temporary accounts, which are revenues, expenses, and dividend accounts. These account balances do not roll over into the next period after closing. The closing procedures reduce revenue, expense, and dividend account balances to zero so they are ready to receive data for the next accounting period. So you may be asking, why do closing entries? Closing entries allows companies to compare sales from year to year to show whether your company is improving or not. If a business wants to compare one year to the other, they have to have two separate totals for each year. Ideally, one wants more sales every year. So if in 2015 you have $85,000 in sale, in 2016 you want more than $85,000. And for expenses, you want less every year. So in 2015, if you have $23,300 in sale, ideally you want less for the next year. The accounts revenue, expenses, and drawings are all temporary accounts and must have a balance of zero at the beginning of the fiscal period. These accounts have not been closed and the amounts are for the current fiscal period. The revenue account is credited and the amount put into that account is $76,250. The expense account is debited and the amount put into that account is $34,000. The drawings account is debited and the amount put into this account is $5,500. These accounts are all called temporary accounts as the balances do not get transferred into the following fiscal period. Real or permanent accounts are assets, liabilities, and capital. Under the assets, there is a debit balance of $66,420. Under liabilities, there is a credit balance of $32,760. And finally, under capital, there is a credit balance of $33,660. All of these balances get transferred over to the following fiscal period because you don't get rid of all of your assets or the amount you owe just because the year changes. It just gets transferred over to the next year and it gets journalized as an opening entry. When doing closing entries, income summary accounts are very important as they are used to summarize revenue and expense accounts during the closing process. First step of closing entries is to close all the revenue accounts into the income summary account. The revenue would regularly have a credit balance, so we would now debit the revenue account in order to zero it out. So here's an example. We have a revenue account and the balance is $76,250. So now we debit $76,250 to zero out the revenue account. But the journal is not balanced, so we need to open the income summary account to credit $76,250. Now we have officially closed the revenue account. So now onto closing the expense account. The expense account have debit balances, so to get rid of their balances, we will do the opposite or credit the accounts. Just like in step 1, we will use the income summary as an offset account, but this time we would debit income summary. The total debited to income summary should match the total expenses from the income statement. In order to know that we did this correctly, the journal entry was done on December 31st, 2016. During this time, all of your expenses should be added up on the credit side of your journal entry. The following expenses labeled on this credit side are wages expense, rent expense, and utilities expense. These accounts add up to equal the expense amount on the debit side. By crediting the expenses on the journal, you zero the balances on account, such as rent expense, salary expense, and utilities expense. The third step is to close the income summary account. In order to do this, total up the debit side and the credit side of the account to determine if the company is making or losing money. If the company has a greater amount on the credit side, you create a net income, which means you make money. But if the greater amount is on the debit side, which is the right side, you would lose money, which is a net loss. As you can see, we have $76,250 credited, which is the revenue amount. We have $34,000 on the debit side, which is the expense amount. We would subtract the two values and get the net income of $42,250. Income summary is a credit of $42,250. The income summary account gets closed by debiting $42,250 in the income summary account, and capital will be credited by $42,250, so it balances out. The last step to close our accounts is to close the drawings account into the capital account. Initially, drawings has a debit balance, so in order to zero it out, we would need to credit the amount in the drawings account and debit it into the capital account. So as you can see on the ledger, we place $5,500 on the credit side of the ledger to balance this account. Then we would take the debit balance of the drawings account and apply it to the debit side of the capital account to balance the transaction. Now you have successfully closed an account for a company. Thank you very much for listening.